Good morning, everyone. My name is Todd Menard. Thanks for joining us today. Today we're going to be going over the Greater Phoenix Metropolitan Housing Market and the statistics for the week ending July 25th, 2022. Let's get right into it. Looking across the board, we have 32 days closed on market. We have a 3.18 month supply. Our absorption rate is at 31.41. Our average list price is down to $715,931. Our average sale price is hovering at about $560,000, and our average list price to sale price retention is under 99% at 98.64. Taking a look at active inventory across the board, we're sitting at 18,182 units. That's a 5% increase over last week. Pending is sitting at 3,690, and closed units for the month at 4,421. We took 2,523 listings this past week, and our active days on market is running at 64.8 days. Taking a look at our price ranges in the bottom right-hand corner, you'll see that under $500,000 represents 48.95% of the entire market, and it's averaging approximately 43 days on market. This is a great portion of the market sheet to look at if you want to find the price range of either the home you're interested in selling or the home that you're interested in purchasing. This kind of gives you an idea of the competition in that price range. Also, it tells you how many homes that are available that would be competing with you, the number of days on market, and the percent of the entire inventory in the MLS that one price range represents. Of course, this does not take precedence over hiring or looking at your local realtor who represents the marketplace and ensuring that you have the numbers for your particular local hyper niche market. Taking a look at the $500 to $1 million price range, of course, the same thing applies. However, this represents 39.6% of the inventory right now and is averaging about 44 days on market. And our $1 million and up price range, although there's many categories on the way up to $15 million plus sale price, $15 million, the average is averaging 11.5% of the entire inventory and about 79 days on market. So let's get right into the spreadsheet. This is where everyone can become the expert. And what I mean by that is that this gives you the ability to compare. And let's face it, having experience is really nothing more than having a historical perspective of comparing properties, comparing sale prices, comparing market data. So let me get right into this and show you how this can help you as well. If we look in the very center column, you'll see there's a column called 2019 SW. That's what the statistics were on the same week in 2019. To the left of that column, we have a salmon column called 2021 SW. That's the same week last year. Now, we still use 2019 as the pre-COVID comparison or benchmark, and then we use 2021 as our year-over-year comparisons. We look to the left of that, we have two weekly comparisons, which is this week and the week prior. So looking at new listings, this past week we took 2,523 new listings. That was better than 2,463 or 76 the week before. Prior to that, we were as high as 2,600 and 2,700 listings, and we've really never gone over 2,600 listings in a week. So people are putting their homes on the market at historical rates at this particular moment. They know where they want to go. Inventory is high, so this is a good sign. So again, that was up just a little bit. The active inventory we said was at over 18,000. Slide your eyes to the right. Last year it was at 8,500, so we're basically over twice the inventory that was available a year ago. And of course, if we take a look at 2019, one of the best years Arizona's ever seen in the real estate market, stable real estate market, we only had 14,600 homes to choose from, and we now have 18,000 homes to choose from. Market shift a little bit again from that under 500,000 more into that 400,000 to 700,000 market, but certainly enough. There's still plenty of inventory. If we break that inventory down, we'll see that 781 of those are in the coming soon category. 15,317 of those are single family non-distressed properties, non-detached also, and there are 2,107 new home construction homes that are in there, and 18,142 properties that are non-distressed in total. So again, some people say, well, what about this distressed inventory? The default rate or the foreclosure rate is up to 7%. Well, it's always between 6 and 8% historically looking back at finance. However, However, in the last 10, 12 years, it's only been approximately 4 or 4.5%. So, when we hear the number has doubled, sure, it's easy for the uneducated to imagine there's going to be a slew of foreclosure properties put on the market. But when you actually track the data, you'll see that that's just a normal cycle, and that's not happening. The sellers, why, and another couple of quick answers to that. Why? It's because sellers now have the ability to find an investment buyer, an iBuyer, relatively quickly, and that way they don't end up putting themselves in the rears of payments and or having to go to foreclosure or filing bankruptcy. So they have a resource to get out before that, which is one of the reasons why HUD and REO and bank-owned sales and courthouse step sales are at an all-time record low. This way over on the left-hand side, you have my rules of thumb. These both are at 0.1 is historical, is somewhere the entire category is usually 0.5%. So we're significantly behind in all of those attributes. Looking at pending. We use pending as a guide to determine approximately what's the temperature of the marketplace. Are there willing sellers meeting willing buyers? And the answer is yes, because when a willing seller meets a willing buyer, they go into contract, they open escrow. The pending section are those properties that are in escrow. So we can take this as a guide to see how many people, on average, in comparison to other time periods, are in escrow at any one particular point of a month. So we look at this right now, it's at 3690. Last week it was at 3664. Slide your eyes to the right. Last year it was at 5,400 people in escrow. 5,600 back in 2019. But just to show you the change in the last 2 months of the marketplace, slide your eyes even further to the right over to here where we have our 4882 and 95, 9151. In 2021 of June, there was 9,000 people in escrow at any one time. Almost 10,000 in the month of May to the right of that. So when we're looking at 3,600 people in the marketplace today, although I'd like you to imagine that about 5,000 to 6,000 is the sweet spot, we're significantly under. We could certainly use more buyers. Well, why? Why aren't buyers entering into the marketplace? Well, we've been talking about this over the last 6 weeks since the first time that the Fed took that Powell indicated that 0.75% hike. What's happening this month? We're going to be seeing. Today's Monday, so we're going to see what's happening this week. Will it be another 0.75% or 1%? Will it be 0.5%? What are they going to do? Well, people, when they hear that the Fed rate goes up, the overnight lending rate to member banks, that tells you that the Fed is tightening their money supply, and as a result, it makes money more expensive to borrow. So as a result, hence the stock markets change, the Treasury notes and bonds affect, and usually they're in an opposite effect interest rate. So we're also in what's called an inverted curve. In other words, our short-term bonds are earning more than our long-term, and normally if you give them you some money for a longer period of time, they pay you more interest. In this particular case, it's the reverse of that, which is not a good sign for the economy. It's one of those economic indicators saying that we're not really stable in that perspective. But again, so consumers hear the sensationalism on television and they say, wow, how's that going to affect me? Interest rates are going up. Well, let's face it, many people that are looking at today's 6% interest weren't in the real estate industry. They weren't even born the last time 6 or 7% was around. They're probably born, but they just weren't an adult, so they weren't cognizant of what was going on. My first house was 12.9%, and I thought I got a deal because the interest rates were 18% back in 1986. So again, this is something for people to take into consideration and watch the cycle. This is just another cycle. Chicken Little isn't falling out of the sky. Wise gas at $5. There's another reason for that, but inflation drives prices higher, which is the same reason why your parents probably paid or your grandparents probably paid $16,000 to $20,000 for a 1,300 square foot home in the 50s. That same home today is $500,000. If you turn around, you see a loaf of bread that was once 5 cents, now it's at $5. All these things are commensurate. Fuel used to be at 25 to 50 cents a gallon. Of course, now it's just expensive. So these are cycles, and don't expect them to go back to anything that you might remember as being normal, because there is no such thing. It's an ebb and flow of a cyclical market that has to feed itself. Just if you want to take the Earth and the globalization and what the Earth needs to do to keep itself intact, that's the same thing. It's going to be an equilibrium that's going to come over time. So historical perspectives allow us to see that. That's why these charts work well. So at this particular moment, I'm basically saying that there's too few people in the marketplace. We could use another 1,000 people. And the way that we can overcome the stigmatization of the fact that the interest rate is higher is that now is the time historically that we've seen banks go into start promoting 3-year ARMs, 5-year ARMs, 7-year ARMs, which is basically keeps the rates consistent for 3 to 5 to 7 years, depending upon the ARM you get, and then it fluctuates thereafter. So what it can do is give you the ability to get into a home, get one of those loans as an adjustable rate, ride out and see what the market will bear. And again, you always have the right to refinance if the rates go down, and of course it protects you in the event the rates are going up. So the other thing is what's called a 2-1 buy down. This is a term that hasn't been around for a decade, but again, it's a subsidized loan. I'm not going to go into it today. Ask your realtor, ask your mortgage professional, what is a subsidized 2-1 buy down loan? Basically, it makes the house more affordable to people, and it's a seller contribution. So from that particular perspective, it works. It's an excellent product. It's not a scam. It's not trying to put the round peg in the square hole. It's just another product that fits a particular time period in which a market is doing exactly what our market's doing now. The interest rates are going up, and that's what it's there for. Let's take a look at closed production. So far, month to date, we're at 4,421 closed. Last year, we were at 6,600, almost 6,700 homes. So we're down about 12%, sliding our eyes to the right. A year ago, as I mentioned, and again, there's a little bit of difference. One's a month-end number, or one's a point in time number. And then, of course, you have 4,600 homes that were 4,599 homes that were at this particular point in 2019. So I'm going to tell you, look at the 2019 good, stable market numbers of 4,600. Look at our number today of 4,421 to 4,400. It's very, very close. It's good. The inventory, it's about the same. The number of people in escrow, it's a couple of thousand short, 1,500 short. There's your big issue right now, why we're not having greater sales, keeping up with our previous productions. Let's go down to the short sale, the lender-owned and HUD closings. Again, there has been less than 0.4% of production sold or closed month to date so far, so it is such a small piece of the market that we're really not worried about that. We're not anticipating any shadow inventory, as they call it. Month supply, 3.18, we were at 3.14. Slide your eyes across. Last year, we were only at a 0.89. That was less than a month's supply. We were using, in 3/4 of a month, we were using almost our entire inventory. If we didn't have new inventory coming in, we would have had no inventory. But our inventory was keeping up with the demand, so our inventory numbers stayed low, although we had the properties available. A year before that, you can see we're at a 1.5 month supply. So this 3-month supply now has been about 4 weeks we've been reporting this, so we're very confident that we're in that 3-month supply range. And let me share right at this particular moment, what's the difference between a buyer's market, a seller's market, and a neutral market? A neutral market is between 4 to 6 months supply. A seller's market is when the inventory falls below 4 months supply. A buyer's market is when the inventory goes beyond 6 months supply. We're nowhere near that. We haven't been near that since prior to the last issue in the 80s. And so again, it's indicating a very stable market. And again, we could use some additional sales, but again, it's not a big deal. All right, looking at average list price, 715, down from 725. Last year it was 712, so there's a good perspective to look at. Average sale price is averaging 560, and remember, this isn't, when you're looking at the average sale prices, you're not looking at the increase in the value of property over time. You're looking at a number that is a product of the number of sales basically divided by the sale prices, and so or vice versa, the total sale prices divided by the number of sales. And so what we're seeing here is 560,000 is the number. That's a awesome number, right in the middle of that $0 to $1 million market. And it also is representative of the fact that it's almost a 50-50 between those two market ranges, those price ranges in those two markets. Taking a look at the average days on market, it's getting tighter. We were at, as low as, 27 days on market, 21 days on market. We're up to 32 days on market pretty consistently. And the bigger picture today is going to be the list price to sale price retention. This means this is the percentage that represents what was the sale price as a percentage of the list price at the time the offer was accepted. This normally averages 97.8% since about 1994. I've been doing my market statistics, and it's averaged about 97.8%, meaning there's been about a 2.2% negotiation reduction in the list prices that a seller would have accepted during a particular transaction. Now we're at 98.64. Slide drives to the right, we're at 101.35, and now it doesn't sound like a lot of money, but it is a lot of money because the prices were inflated last year, where they're not so much right now. So that's what's happening in the marketplace. Thanks for joining me. Next week we'll have our next set of slides out. If you're looking for us, you can find us on Alexa Flash Briefings. Just go and ask to play the West USA Realty Market Analysis. You can find us on Instagram, TV, Apple Podcasts, Google Play, Spotify, and weekly you can go to the youtube.com/West USA Realty and find my play channel, and it'll be there. So thank you very much, everybody. I really appreciate you joining me today. Please come back next week. Look forward to seeing you. Have a good day. Bye.